When you enter retirement, you want to free your wealth from the market swings and the life events that can hold back your portfolio. Phil Telpner can help you find that financial freedom you deserve. This is the Breakout Wealth Podcast.
Welcome to another exciting edition of the Breakout Wealth Podcast with Phil Telpner at Breakout Private Wealth. I'm Ron Stutz, and we're having a conversation today about surviving a bear market, and it's something that we all need to know right now. And Phil, it's great to be back with you. I'm looking forward to your wisdom and wit.
Hey, Ron. Great to be here, and this is a very timely and important topic for sure.
Yes, it is. And let me give everybody your phone number so they can get a conversation with you and end some of their financial anxiety. And then we'll get rolling here. 224-616-2016. 224-616-2016. That is your number to call if you like a 15-minute conversation to talk about some of the financial concerns you have, to get to know Phil, and you guys can decide if you'd like to work together. One more time, that number, 224-616-2016. And Phil, I know you've been doing this financial planning business since 1987. A long time.
Yeah, it's been a minute.
You've seen a lot of twists and turns over the years, but, you know, it's no secret right now. The stock market is in turmoil. We're in a bear market, and the R word, recession, is getting thrown around daily in conversation. So what can you do to survive bear markets like the ones we're in now? We've collected advice from various commentators and so-called experts from all across the nation. You might have even heard some of this advice yourself, but should you follow it or proceed with caution? Phil is going to tell you. We'll break down the guidance to provide some important context and perspective, but this is all about surviving a bear market. And would you call this a grizzly bear market? Phil, it's a rough one.
Yeah. Well, there's a great quote. Howard Marks, who has been running Oak Tree. It's a big fund for quite a long time. And he writes notes, and I follow his writings. I think he's obviously brilliant, but really does a great job of kind of summarizing where we are at in the market cycle without making projections. Mm-hmm. And I think his line is something like this: it's only when the tide goes out do you see who's swimming naked. And I think that's what we're seeing now. This market has moved from a monetary market, meaning driven more or less by free money, to a fiscal market, which basically means that companies, stocks, countries for the most part, have to stand on their own. And the market's just adjusting to that as it needs to, as it should, and is probably overall very healthy.
Yeah.
But it has exposed a lot of people, managers, individuals who have only seen one type of environment, who are of the false belief that whatever they buy, they could just buy more of it, always comes back. There's a bunch of these things, and I just think, unfortunately, they're getting exposed here. So that's kind of the part of the cycle that we're at.
What was that guy's name again that you mentioned?
Howard Marks, Oak Tree. Sign up for his essays or his blog, I guess you will, his videos. He's not a guru. We're going to talk here about some gurus, people that think they're gurus. He doesn't, he's not like, what's his face, that fool on TV that screams and yells and talks about stocks. He brings context of markets much more on a behavioral approach. And I just find it fascinating. And it really helps me reinforce where we're at and how to communicate that to my clients. He's great.
I've got some other folks here who may or may not be gurus, but there's an equity strategist by the name of Phil Orlando who says he expects the market to decline further over the summertime, perhaps an additional 10%. And he favors value stocks in energy, financial, and healthcare industries over growth stocks. He also says holding cash hasn't been this attractive in more than 20 years. Do you agree with Mr. Orlando?
I don't have a crystal ball, and neither does he. Let's talk about this for 1 second.
Okay.
What he's saying here is just what we spoke about before. This is a interest rate type of thing. Value stocks generally will or can perform better in an environment like this. Growth stocks have been driven by interest rates. They generally do not perform well in this, and holding cash. Again, this guy must be a genius because obviously interest rates are higher than they've been in forever. I don't know if he's talking about putting your money in the bank. I'm still not sure that that's a great idea as an investment. Not something I would recommend. Here's my point with this. Every time I read this, I get it. This gentleman, I think they run a pretty big value fund, so he's probably also talking his book, which is fine, but people should understand that. I just push back on somebody that knows what the future is going to be. The last time I checked, and Ron, maybe you'll agree with me or not, the future is unpredictable, correct?
Yeah, that's for sure.
So if the future is unpredictable, which is actually good, by embracing the unpredictability of the capital markets, we as investors get paid to take on that risk. If we knew, or Goldman Sachs knew what would happen, there would be no risk premium. We would not be compensated for taking that risk. The market would be like a CD, right? No risk. So that being said, risk management starts with portfolio construction. So properly constructed portfolios managed correctly and rebalanced correctly give us the best shot of harvesting that premium that we get for not knowing the future. Wow, that was kind of deep, but I don't know. I mean, Ron, what are you going to have for lunch? You probably don't even have any idea.
I have no clue.
Right, exactly. So I think these guys, sometimes they try to add certainty to an uncertain environment, and I think it's pretty disingenuous. Just my opinion, but
yeah, I get it. Listen, plan, and grow. That's what it's all about with Phil Telpner. You're listening to the Breakout Wealth Podcast. Again, if you'd like to call Phil and have a one-on-one conversation with him, the number is 224-616-2016. We'll give that number again at the end of the podcast. I started to say pop quiz. We had a pop quiz recently. And
no more quizzes. I'm still sweating. Yeah.
No need for that. And there's a financial journalist by the name of Bill Stone who says there's a silver lining to this horrible recent review of the stock and bond market damage, in that there's a decent amount of bad news baked into asset prices already. Now, this guy, Bill Stone, goes on to suggest that timing the end of a bear market is impossible, but that the eventual rebound is typically explosive, and look for it to happen before the economy recovers. What do you think of that?
I think he's spot on. Let's remember that markets discount the future, and we just talked about, since that future is unknown, they take their best shot at the future. So feels like right now markets are discounting inflation. They're discounting lower earnings. They've definitely discounted rising interest rates. These markets were not good in January, long before anybody was talking about any of these things. So this gentleman's point, I think, is really spot on. And here's where people get in trouble. At the bottom of these cycles, the news will be just awful. Always is. Recession, gas lines, you can just extrapolate that to anything. The turn in the market comes long before that news is out, because the market looks forward, right?
Right.
So, when I was trading for the fund, one of my favorite trades, and very highly profitable actually, was when bad news didn't cause the market to go down. Let's just take a simple a simple example. If the street's looking for terrible earnings on a stock, and the earnings comes out and they are terrible, but the stock doesn't go down anymore, or even heaven forbid rallies, that is key information to know that the market has already discounted the bad news. And that's what this gentleman's saying here. So I think that's really solid advice, not actionable, but solid advice.
These things move along quickly, and it's sort of like, somebody coming in and saying, "Hey, Phil, I got a great stock tip." Well, it's probably too late. If you've already gotten a great stock tip from your brother-in-law, it's probably too late because
or illegal.
Yeah.
No. The good ones, by the way, are illegal. So please, no stock tips for me.
Yeah, I read earlier this week, there's a columnist and financial advisor, Grant Sullivan, I guess his name is pronounced. He says to beware of making emotional decisions in turbulent times, and that making those kinds of mistakes can be more costly than you think. You've said that in so many words a lot of times.
Yeah. Well, I just would ask Grant, when is making emotional decisions actually a good idea?
Exactly. So, yeah, when you're in some kind of emotional upheaval, like a spouse dies or something like that, I mean, you don't want to make important financial decisions right then.
No. Let's... I'm going to be positive, Phil, today.
Yeah.
So you like that, Ron?
Yeah, I do.
It's positive Phil day. Let's say you own your business and you just had a liquidity event. You sold your business for $100 million.
Oh, good.
Well, you want to give that some time to sit into. What I'm trying to get at is there's not just negative emotions, right? There could be all types of emotions. And honestly, one of the things I do, and kind of a humble brag, one of the things I'm really good at is helping people manage those emotions, or acting like a buffer in between those emotions and people taking action, right? Mm-hmm. So very important here, money is loaded with emotions for everybody. We don't need to be ashamed to say that. That's perfectly normal. Volatile markets, watching your account. Hopefully you're not watching it, but if you are, watching your account go down 10% a month is never comfortable. But like I alluded to earlier, risk management happens during portfolio construction. Mm-hmm. Okay. It also happens during financial planning. Do you have a cash cushion? All these things that we repeatedly talk about. Once you're in it, that's too late. And by the time you have that feeling in your stomach and you can't take it anymore, call me, because that's probably pretty close to the bottom.
Yeah. Okay. Here's, I don't even know the person who said this, but the head of a national retirement resource organization said, quoting here, "If it were me and I was going to declare I'm retired and have my retirement party, I'd look to delay it a year or even 2 years if I could." Does that make any sense to you?
Again, these guys and their quotes. I just my standard answer is it depends.
Yeah.
Do you have a pension? Do you have more money than you're going to spend? If your plan was to just live off your investments, yeah. Taking withdrawals out now, obviously, in a declining market is never great, except for RMDs. I think you have to have a cash cushion. For some people in retirement, maybe that's 5 years of spending. Yeah. I don't think there's any shame in that. You want to be comfortable. You do not want to be like burning your eyeballs out watching CNBC at 4 o'clock in the morning to see how Europe opens. It's not healthy. Yeah. So I think to avoid that, you really need to get good advice.
You don't want to have stress in your life all the time, that's for sure. And I was just thinking about something, Phil. 10 years from now, somebody's going to be doing a financial podcast, and they're going to say, Phil Telpner, a financial advisor, once said, "This sucks. What do you think?"
Yeah, right. This sucks. I mean, that's sometimes this sucks sums it up, right? And, I mean, I pride myself on being honest. So
you always get straight talk with Phil. There's no question.
Well, if you want something else, we're not going to get along too well. So
Yeah.
I'd be happy to refer you to somebody else, but this is a serious business. Kind of an aside. Sometimes you have to tell people not what they want to hear. Mm-hmm. And I don't mean to be an ass about it, but that's the value that I can help people with, right?
Yeah.
It's not putting anybody down. Everybody has their own unique situation, starts where they start, and life is, it throws everybody challenges. But we're all adults, and you just have to be honest with somebody and tell them where they're at, what's reasonable, what's sustainable, what makes sense. Unfortunately, some people live on Fantasy Island a little bit, and they're just not right fit for me. I don't run my practice like that.
Yeah, with Phil, you always get honesty, no matter whether it's something you want to hear or not. Hey, let's wrap up this whole discussion today with Warren Buffett. I can't think of a financial conversation that, folks have all the time. I always mention Warren Buffett, it seems. But he has a couple of famous pieces of advice that both apply during down markets, but they seem a bit contradictory to me. Help us reconcile these two for investors and those who are getting ready for an work optional lifestyle, Phil. So I'll leave this one up to you. He said, the most important thing to do if you find yourself in a hole is to stop digging. But he also said, be fearful when others are greedy and greedy when others are fearful. What in the world do those two statements mean?
Oh, Uncle Warren.
Find yourself in a hole, stop digging, he says.
Yeah. All right. So what he's talking about is losing positions, probably, and taking a reasonable loss before it turns into a catastrophic loss. Mm-hmm. Don't forget, Warren's in a different business than we all are, okay? Right. He's buying companies, right, and trying to hold them forever. He's also had a lot of mistakes and huge losers too.
Sure.
So he is a human. The guys that run Berkshire are humans. They make mistakes. They get it wrong. They just don't stay wrong. So I think let's extrapolate that to our current situation. I actually like the way that sounds. They can be wrong. They just don't stay wrong. An individual investor now may have been overexposed to growth stocks, and it has worked well. But now is the time that they should ask themselves, it's okay here to be wrong and make some adjustments or get some help. You just can't afford to stay wrong, right?
Yeah.
And people tell themselves stories about stocks, and I don't want to go into that, but a stock is not a story, right? A stock is just an investment. I love this last line, and I thought it was Ben Graham, who I think was Warren Buffett's mentor, but whatever, be fearful when others are greedy and greedy where others are fearful. Buy when there's blood in the streets, all those kind of taglines or quotes, if you will. What that's really saying is, and this is probably a great time, and maybe is you want to buy the market, you want to buy asset classes when they are on sale, on a discount, right? What that discount is, we don't know because, again, we don't have a crystal ball. But still, that's why, like we talked about before, all my clients are making monthly contributions now. I will not take a client that is not making contributions every month. I think this is a generational wealth building opportunity. If this market sucks, there's another technical word again. If this market sucks for a couple years, so be it. We're going to take advantage of it. We're just going to keep buying. because in 10 years and 15 years and 20 years, the compounding of those actions will make generational wealth. Now, caveat to that, they don't ring a bell at the bottom, right? There's no all clear. By the time the average investor thinks that it's okay to buy stocks, they've missed on the opportunity. We take advantage of that on a portfolio basis versus rebalancing and some technical stuff. Important, just not on this for this venue. But you absolutely have to take advantage of this. Whether it's $50 a month, $100 a month, $10,000 a month, $100,000, whatever your situation is, these are the times that lay the groundwork for all that success in the future. How was that?
Gosh, a lot to take in there.
Got it?
Yeah, I got every bit of that. I can recite it back to you word for word. But give me a little while to get my thoughts together.
Right.
Wow. Hey, it's been a lot of fun talking about all this. I just want to ask you one more thing
Sure.
before we go. Is there any other specific advice during this market turmoil that you're sharing with your clients other than the fact that you want to make sure they're putting something away every single month?
My message doesn't change, actually, believe it or not. Maybe now I'm emphasizing avoid the news or just don't pay attention to it if you can. The news, whether it's CNBC or CNBS, as I call it, or any of these other entertainment channels, is not there for your benefit. It's there. A lot of it's fear-based. A lot of it's to keep your eyes glued for the next commercials.
Sure.
It's driven by personalities and not investment advisors and not people giving fiduciary investment help, I guess, advice. A lot of this, my clients now, always communication is key. Any questions, concerns, anything, I'm just reinforcing that we can set up a time to chat. To your point about making emotional decisions, to my earlier point about risk management starts at portfolio construction. Now is not the time to be thinking of risk management, right? Although it's embedded in what we do. And honestly, thankfully, we've built up cash cushions and all that kind of foundational stuff. And you just we'll just carry on, right? Just carry on. But those have to be, I see way too many people that have an advisor or what do they call it, a portfolio guy or an investment guy or something with no communication.
Yeah.
Markets go down, they don't man up and start and talk about it. They're afraid of questions. They're afraid to get fired or I don't even know. They promise some kind of bullshit that's not working and they're afraid. And that's not me. That's not what we do here. So we welcome conversations, video calls, in person, whatever it is. Let's talk about it. So.
Got to keep those communication lines open, that's for sure. And
very valuable, very valuable.
Again, it's been fun today. You passed along a lot of good advice to folks, and I hope they will place a phone call to your office so you can talk one-on-one.
Happy to do it, Ron. Thank you.
You've been listening to the Breakout Wealth Podcast with Phil Telpner. You always get world-class advice with down-to-earth conversations. The number to call if you'd like to have a conversation with Phil, wherever you are in the greater Chicago area. You can have a virtual conversation via Zoom or some other form of technology, or you might want to come into the office, 224-616-2016. That is 224-616-2016. Your number to call. Of course, to find out anything about the business, you can book a time online if you like at breakoutprivatewealth.com. That's breakoutprivatewealth.com. But again, that phone number, 224-616-2016. Specializing in ending financial anxiety. His name is Phil Telpner. You've been listening to the Breakout Wealth Podcast.
Breakout Private Wealth, LLC is a registered investment advisor located in Glenview, Illinois. Today's content is for informational purposes only and does not constitute tax, investment, or legal advice. Please consult with a qualified professional before taking any action.